Hi, everybody, and welcome to the second quarter of 2026 Capital Market Review. This report will talk about all the things that happened in the second quarter of the year. We may very well touch on some year-to-date things as well. As we do typically every quarter for the Capital Market Review, we identify a theme, and the theme is typically presented as a song title. Well, since this recording is just after the 4th of July, I thought nothing better than to use America the Beautiful. America the Beautiful, the song, was composed as a original poem well over 100 years ago, 1894. It was then set to music. It was a hymn, actually, that was written a decade or two before that. Since then, it's been recorded hundreds and hundreds of times. My favorite is Ray Charles, recorded originally in 1971. Very soulful. If you like America the Beautiful, listen to his rendition. I think it's terrific. As we do every quarter, we record this message as an attempt to get a better idea of where we are and, more importantly, where we're going. The economy does cycle, and it's important to understand where we are in the cycle and also have a better understanding of what the Fed might be up to next. Are they going to lower or tighten rates? Because that has an effect on interest rates, economic growth, and so on. Our agenda is neat. We're going to cover essentially two things. We'll talk a little bit for several slides on the economy. We'll talk about inflation and labor and all those issues. And then we'll see kind of what happened with the market over the course of this last 3 months and then also year to date. So let's get right into it. The first slide I want to talk about, which really had everything to do with the news cycle this last 3 months, and certainly since the beginning of the year, it's all about oil and the economy. The red line that you see on the left-hand side represents oil this year. You'll see the huge spike that we had going into the March timeframe when hostilities with Iran took off. And you'll see that the oil prices have since fallen at least through June 30th. And that's helpful. It certainly will put a pall on inflation and maybe at some point in time allow interest rates to moderate. Unfortunately, since June 30th, hostilities have resumed. And in just the last 2 or 3 days, oil is up 7 or 8%. So we'll see how that shakes out. Oil as a component of the US economy, much less than it used to be. This isn't an OPEC oil embargo situation. In fact, as you can see in the upper right-hand chart, we're actually net exporters of oil. So it doesn't have nearly the overall impact. It still has an impact on transportation costs, et cetera. And for certain consumers in our economy, especially those in the low income ranges, it has a major effect because a much larger component of their overall annual spend is on fuel, energy, and whatnot. So we'll see what that looks like. We can see it having an effect as we see consumer credit default rates on credit cards and buy now, pay later, et cetera, continuing to rise. So this will at some point have a slowing effect on the economy. When we look at economic growth, there are essentially two key drivers. The first is labor growth. Consider that the size of our labor force. It helps to grow the economy. The bigger the force, the more the labor force grows, the more positive impact it has on economic growth. And the other is productivity. Lately, the story has been productivity with this huge, enormous spend on AI. And part of the reason for that is we're not seeing the labor growth. And we'll get into that in a moment. Effectively, we have this confluence happening right now where we have demographic headwinds at the same time that we have or are hoping to have technology tailwinds. So we'll see how that plays out over the course of the next several months and certainly into next year. As I said, there are two main components to GDP. labor as well as productivity. Last year, we had a bit of a pop in economic growth. Some of that came from trade rebalancing. We're not expected to see much of that this year. So that creates a little bit of a concern as to exactly what kind of growth rates we see. Additionally, going into the beginning of this year, we thought we'd get a kind of a shot in the arm in terms of stimulus from the one big beautiful bill, that huge fiscal stimulus bill. However, because of the hostility with Iran, because of the increase in oil, and certainly the rise in inflation costs and household expense costs, a lot of that extra shot in the arm, the extra stimulus, has been offset by higher prices. So it may wash a lot of that out, and we might not see the big stimulus package. The only other hope that we might have is there might be some tariff checks as rebates given back to corporations. I don't see that happening much before the midterm election, but that may in some way move the needle a little bit. When we look at labor, there's a confluence there as well. We have the issue with immigration. Immigration has stalled, and as a result, it has really stalled the number of new workers we have. Additionally, demographically, we have our aging workforce kind of timing out, and they're retiring out. And we're seeing a reduction in household jobs kind of across the board. Additionally, the hope to countermand this, an increase in productivity in and of itself might create the seeds of further strain on labor as technology replaces workforce as well. So we're going to really need to watch this as it unfolds over the course of the next couple of years. Bottom line, GDP growth has a series of headwinds. Turning to inflation, we had hoped that inflation peaked in May or so of this year. It looked like we were talking about a ceasefire and then some peace. The print was about as high as it got. We were expecting that would be about it. Too soon to tell. We now have kind of an upswing in military activity. As I said, oil prices have started to rise. We'll see if that has an effect on longer term inflation. We would expect at some point this hostility will be over, and we would assume that interest rates will start settling down. It's in the government's best interest to lower interest rates, just considering the sheer total amount of debt that the government owes and the amount of interest that it pays. Turning to interest rates, it's sort of on hold. At the beginning of the year, we were expecting, or I should say, what was baked in the cake were 2 Fed cuts. And everybody was anticipating that early in the year. And then things changed. Kevin Walsh was appointed chair of the Fed. He's a bit more hawkish, more apt to keep rates high, more apt to not use the government's balance sheet to stimulate the economy. And at the same time, we also had the Iranian hostility. As a result, since then, the 2 rate cuts anticipated have become 2 rate hikes going into the end of the year. There is still a lot of talk and communication around these possible rate hikes. At this point, the Fed is on hold until further information unfolds. Where interest rates are today, higher than they were at the beginning of the year, it is certainly putting a ton of pressure on fixed income bonds. Doesn't matter what kind of a bond you own. Doesn't matter how long a period of time the bond is until maturity. It's probably a little bit underwater year to date. We have seen Treasury bills and bonds and notes all returning negative principal returns year to date. That makes money market a much more attractive investment. 3.6-ish% yield without volatility seems a lot better than a 4.1% coupon and a 1.5%+ loss in principal. So that's kind of where we are. That said, there's no compelling reason to do anything with bonds right now. There's not a big reason to own more. There's not a big reason to increase duration. It's wait and see. That said, should the economy stumble, we would certainly expect interest rates to fall. We would expect bonds to rally, but that rallying of bonds may be a bit muted because at the same time, we might still have inflation fears. We also have uncertainty as to higher interest rates. And certainly the Fed itself, or I should say the US government itself, will have the pressure of the amount of interest it owes every year, well over $1 trillion a year. So that will put some kind of a cap on the amount of rally we may very well see with respect to bonds. So the big story the last several years has been certainly the stock market. And that's been a big story related to large cap stocks, directly related to AI spending. The result of that, though, has created a situation where large cap growth, big cap stocks, are not only over concentrated, but they're certainly overvalued as well. This has set up a situation where we're beginning to see better value elsewhere, and the market is beginning to broaden out. Other areas of the market that have somewhat lagged behind the last several years are really starting to outperform, and they're getting flow as well. Professional managers are beginning to reassess this dynamic and invest accordingly. By doing so, that also offers an element of additional diversity. It's not just over-concentrated large cap. Another element of diversity would be investing internationally. International investments boldly outperformed the US last year when the dollar was weak. It was outperforming the US market early this year. And since the Iranian war, et cetera, the dollar has really strengthened about 2% this year already. So that's put a little bit of a headwind. But longer term, international securities offer far more value. They're frankly cheaper than the US market. And they certainly offer a greater element of diversity than just a US concentrated portfolio. With that, let's take a quick look at kind of how the quarter and the year to date is shaping up. The S&P 500 was actually down in June, but it was up over nearly 15% for the quarter. Now, that said, it ended year to date up 9%, which implies that first quarter, if you remember, markets were generally down. The S&P was down a good 5+%. As I said, we're getting a broadening out. If you consider things like large cap value year to date outperforming the S&P. It was also outperforming for the month of June. International securities, as well as gold, see a little bit of headwind. Part of that is because of the strength of the US dollar. The dollar was up almost 2% June alone, and the dollar is up 3% for the year. Last year, the dollar fell nearly 10%, creating a huge tailwind for gold and international. We're seeing somewhat the reverse of that. This broadening out is in part a movement away from some of the Mag 7 or the large cap AI stocks. Make no mistake, they still have a huge impact on the S&P because of their concentration. But we're beginning to see some weakness in terms of performance. If you look at Microsoft MSFT, it's down 21% year to date through June 30th. It was down nearly 19% for the month of June alone. NVIDIA is up 5% for the year. The S&P or value stocks are actually outperforming NVIDIA. We haven't been able to say that in 3+ years. So the more weakness we see here, the harder it is for the S&P to kind of get out of its way, giving the opportunity to other securities. And that's kind of where we see things. The other risk, is there's still super concentration with respect to AI in general. There was a report, JP Morgan, I believe, that talked about AI exposure to the S&P beyond just Mag 7. We'll call it AI adjacent. The best way of understanding that is, look, we talk about NVIDIA and chips, but AI has also had a huge effect on advanced micro devices, Taiwan Semiconductor, Intel, Broadcom, Qualcomm, et al. So what about all the S&P, and have there been certain stocks that have been skewed up because of this buying frenzy? In total, based on market cap, the JP Morgan analyst figures that as much as 57% of the S&P is, let's call it, AI adjacent. So should the spending cool or the concerns of continued growth cool, that creates a lot of headway for that index. And I think that's also one of the reasons you're beginning to see other areas start to outperform. Well, that's it for the quarter. We'll talk to you again, next month for an update, as well as a full capital market review for the third quarter. If you have any questions, please reach out. And as always, thank you for your support. If there's anything we can do, please let us know. Take care and enjoy the rest of the summer.